Hi everyone, welcome to the webinar and workshop series conducted by TCS in lieu of the upcoming MCS exams happening in May 2025. My name is Nick and I'm one of the lead tutors for MCS at TCS, and today's session will be primarily conducted by Jared, who is our co-tutor, and he will be taking you through the latter parts of today's session. So let's look at the session outcomes. So first things first, I'm going to share some general feedback with you from our latest round of marking, because 3 answer scripts had already come through pertaining to MCS Mock 3. So we have already marked 3 of these papers. There's 2 more pending which came in last night. So based on the findings after marking your papers, I will be explaining what your shortcomings are. And also, Jared, after I've provided the general feedback, Jared will be providing an overview into the F2 syllabus, and also followed by a discussion of a mock exam tied to your F2 syllabus, thereby taking you through the answer plan and conducting a masterclass based on the question which we are going to focus your attention towards in today's session. And at the very end, we are also conducting a Q&A session. Those of you who had already attempted the mock exams, definitely you will have questions. So make sure to ask questions and get them addressed at the Q&A session. All right, so let me quickly remind you of the upcoming workshops which we have scheduled for you. So we are doing 2 more workshops concerning your P2 and E2 syllabi. So just like in today's session, Jared will be taking you through the syllabus concepts covered under your P2 and F2 syllabi, and at the same time P2 and E2 syllabi rather. We have done a blunder here, extremely sorry about it. And at the same time, he will take you through mock exam and its suggested answer, or the answer plan concerning these 2 syllabus elements. All right, so first things first, let me give you general feedback based on what we understood after going through your 3rd mock exam. So the biggest issue which we found out was the fact that most students were providing generic or vague explanations. So this is quite normal, because you are still getting your grips with the answering technique. And I felt that some of you who probably, because you are coming through an exemption route, since you are not too conversant with theoretical elements, you might have provided vague answers. And at the same time, sometimes I felt that some of you has not understood the requirement clearly. That is when you are clueless of what you're supposed to achieve, there's tendency for students to, beat around the bush rather than actually focusing at the requirement, or trying to address the requirement. And also, I feel that you are still struggling with your application skills, because you need some practice to master it. So that's why it's essential that you attempt a mock exam under exam conditions. After doing so, you have to go through the master classes and the answer plans, and as your final step, you have to redevelop answer plans. This is when you are actually practicing your application skills. You will learn your application theoretical knowledge and application by watching the master classes, but just watching won't help you. You need to test and see whether you have gained something out of these master classes. That's exactly why you need to redevelop answer plans. So when doing so, do it leisurely. Don't time yourself when you are redeveloping answer plans. So for instance, after watching the master classes, go through the answer plan for section number 1. After doing so, keep it aside and try to redevelop the answer plan for section number 1 on your own. And once you have done so, compare your fresh answer plan to see TCSs to see whether you still have shortcomings or knowledge gaps concerning the way in which you are supposed to develop your answer plans. And once you are satisfied with this process, move on to section 2. Again, go through the answer plan provided by TCS, then redevelop your answer plan on your own, and compare your fresh answer plans to TCSs, and move on to section number 3. So you need to go through this process. You will be struggling at this moment. That's quite all right. You will feel demotivated after attempting the mock exams, because they are quite tough, I have to be honest with you, because it's good that you are struggling right now rather than at your real examination. So that's probably why, since you are still struggling with application skills, still trying to get your bearings with certain theoretical concepts, still trying to get your gain a clear understanding of each requirement. Probably due to these reasons, you ended up providing vague explanations. Also, one of the students, when going through this answer script, I felt that actually, Jared and myself both felt this. We felt that this individual has provided highly theoretical answers, which should not be the case, because at this exam, as you know, as I mentioned in the webinar series, 50% of weightage is provided towards testing your theoretical knowledge, and 50% of weightage is provided towards testing your application skills. So just because you know your theories, you cannot pass this exam. Instead, you need to work on your application skills, because you need to remember that you are playing the role of a finance manager who is operating in a real life corporate environment. So in a real life corporate environment, whenever your superior sends you an email, will you try to explain theoretical concepts, or will you utilize your theoretical knowledge and apply it when developing your evaluations, or when coming up with your recommendations with the intention of addressing the requirement at hand? You will always, at office, you will always focus on applying the conceptual knowledge which you have gained via CIMA. So you need to replicate a similar methodology within this exam as well. So there's absolutely no point of dumping theory or developing theory-heavy answers. This is not the OCS exam. At this stage, you need to really work on your application skills, because you are not at the operational level. Instead, you are located at the middle level of your chosen organization. You are playing a managerial role. So as a manager of this company, definitely you need to work on your application skills. So you can always improve these things, when you watch the master classes and redevelop answer plans. Also, again, one single student had developed an answer which is not in paragraph form. So it appears that you might have misunderstood what we taught you in the third webinar, answering technique. So you are expected to dedicate 5 minutes of your time to read through each scenario. After doing so, you are supposed to dedicate something like 20 to 25 minutes of your time to develop the answer plan. And once you have developed the answer plan or the answer structure, then utilizing the remaining time, you are supposed to expand the answer plan in paragraph form, thereby developing a paragraph per answer point. So if you intended to include 5 answer points within a certain subtask, then in your final answer, you need to have 5 different paragraphs. So always make sure not to develop answers in bullet points or provide answers in single line sentences. You won't get any marks if you do so. Instead, as per the CIMA examiner's comments, which appear within the exam blueprint, which I highlighted in last week's webinar, you are supposed to develop answers in paragraph form. And also, I felt that almost all the students, when going through the answer scripts, almost all the students had not written the required number of points, or not included the required number of points within each subtask. Again, this is quite normal, because you are attempting you are practicing this answering technique for the first time, and at the same time you are attempting these mock exams without referring to the answers. So if you have knowledge gaps, especially if you are coming through the exemption route, you will definitely have knowledge gaps. If so, you will struggle a bit at the exam. So although you are in a position to determine how many points you need to include. For instance, based on the weightage provided, I said that you are supposed to determine the number of points which you need to include under each subtask. And let's assume you intended to include 7 valid points, but you can only come up with 4 valid points due to your knowledge gaps concerning theoretical concepts. So that's quite all right. It's best that you are exposed to these type of issues, which highlights the fact that you have knowledge gaps. It's good to understand that you have knowledge gaps, which can always be fixed when you are watching the master classes and when you take steps to redevelop the answer plans. And in one single answer script, we didn't like the language which we have used. It was unprofessional. It was like you were, talking to a friend, which should not be the case. You are reporting to your senior finance manager. And as I mentioned earlier, the examiner is trying to replicate a real life corporate environment. So, you might be friends with your manager. That's a different story. Your senior manager but when responding to an email, you'd try to be professional. And at this exam, you have to be professional. If not, you won't gain marks at your real examination. So these are the major shortcomings which we understood. Don't worry. Probably, we were talking about your answer scripts, your shortcomings. That's totally fine. Our process is to understand shortcomings and take steps to avoid them. And when attempting the remaining mock exams, make sure that you take steps to overcome these issues in the upcoming set of weeks. All right, so that's what I wanted to say. And let me quickly tell you what we offer at TCS before Jared takes over. So I'm on the MCS page, and as you know, we offer two packages, the essential course and the premium course. The essential course is intended for those who are coming through the general route, those who have, completed their OTQ exams. Since you have already completed your E2, F2, and P2 OTQs, you already know your theories. Simply, when preparing for this examination, your job should be to improve your application skills. So if you get your hands on the 6 mock exams with suggested answers, you stand a chance to significantly improve your application skills. So under the essential course, you would gain access to the recordings of weekly webinars and workshops, the 6 mock exams and suggested answers, which is the most crucial asset which is included under the essential course. And we have made sure to cover all syllabus areas within these 6 mock exams. And along with it, you'd get some additional resources so that you gain a good understanding of what is highlighted within your pre-seen document. So the essential course is priced at £249. And yes, and talking about the premium course is developed for those who are coming through the exemption route and those who had failed the MCS exam previously. So both these sets of students have the same problem. There are gaps in theory knowledge and application. That's what we understood by going through your answer scripts as well. There are significant gaps in theory knowledge and application skills. So in order to fix these problems, we have added certain or included certain additional resources under the premium course. So on top of what comes with the essential course, you'd also gain access to the online mock exam platform on which you can attempt all 6 mock exams under exam conditions, which is the best way to master your answering, time management, and stress management techniques. You will also gain access to answer plans of all 6 mock exams, which makes your life easy when it comes to understanding the logic behind each answer, how to structure each answer, and how to work on your application skills, how to apply theoretical concepts when developing answers. All these things can be easily understood when you go through these answer plans. And these answer plans will help you when conducting revision, because as I mentioned earlier, you are supposed to redevelop answer plans. So when after redeveloping answer plans, you are supposed to compare your fresh answer plans to TCS's. So, you can, in a jiffy, understand what your shortcomings are, which is tied to answer structuring. And also you'd gain access to 20 masterclasses. We have developed masterclasses from mock exams 2 to 6. And the objective of developing these masterclasses is threefold. We are trying to teach you the logic behind each answer, trying to teach you the theoretical concept covered within each and every mock exam, and at the same time, trying to highlight application skills. So the premium course is priced at, Jared, hope you can scroll. Yes, the premium course is priced at £649, which can be paid in 2 installments of £324 each. Or if you opt to pay in full, you can save £100. If so, the price is just £549. So you can see that we have deducted £100 from the premium course. Why is this the case? Because we have gotten rid of tutor feedback, which was previously included within the premium course, but the first 15 seats are already taken up. So because of that, we are not offering tutor feedback anymore. And for each paper, since our cost is £50 per paper, we have reduced £100 from the premium course. So although you won't get access to tutor feedback, you will benefit from the masterclasses and the answer plans. So if you have theory gaps or knowledge gaps concerning theories or application issues, simply go for the premium course. All right, so that's what we offer. Having said that, I'm handing over the proceedings to Jared. Jared, over to you.
Thank you, Nick. Hi, everyone. Welcome to the first workshop conducted by TCS for the upcoming management case study examination. So as we start the workshop, I would like to take you through the F2 syllabus overview, and I will use the TCS mock exams coverage document to highlight the areas that are important from F2 perspective. So remember, you have an exam blueprint. Yes, you also have the F2 study text, and those who are enrolled with FLP, you will have the competencies. But I've organized the content in a simpler and a more straightforward way so that you will have a clear breakdown of the different areas that you need to be thorough with in terms of F2 or advanced financial reporting. So we start with sources of finance. So remember, there are two main sources of finance, equity and debt. So just be familiar with the different options we have with regard to equity. We can go for a fresh share issue. We are a listed company, Trimayr. So obviously, it will be easy for us to issue new shares and raise funds through the capital market. We could also consider a rights issue, and we don't have any information about any other types of shares that we have issued. For instance, we could issue preference shares, but we have not been provided with any such funding as per the financial statements. So you need to know what would be the implications of financing through equity, especially on the capital structure. Remember, the gearing ratio is a key consideration when it comes to sources of finance. And remember, although a new share issue, a rights issue, or share for share exchange in the case of an acquisition may seem the same, they will operate differently, right? So you need to understand how choosing a particular mode of equity finance can impact the financials of the company. So don't worry, we are covering these different scenarios within our mock exams. So just some heads up for those who are yet to attempt some of our mocks, just be prepared. We are looking at the implications of equity finance and debt. Remember, the fact that we are a listed company opens up the possibility that we can raise debt in a number of ways. We could go for a bank loan at its very basic and easiest form, or through the capital market, we could issue debentures, or we could consider bonds. So you will encounter such scenarios in the examination, or which is something we also cover in our mock exams. So please remember that compared to a bank loan, the way that we will have to go about a debenture issue or a bond issue is different. So as part of your preparation, please try to understand how the different options with regard to debt will impact the company. And related to sources of finance is the concept of weighted average cost of capital. And I cannot tell you enough about how many times this topic has been tested in the examination. It is important that you have a clear conceptual understanding of what does the WACC represent. And since we are a listed company, WACC is of paramount importance for us. So please make sure that you have a good understanding of the concept of WACC, its usefulness. And if you look at past exam questions, you will see that the examiner has been interested in testing the suitability or the limitations of using the company's WACC as the discount factor in investment appraisal or project appraisal. So it's an upcoming question in one of our mock exams, and I'm giving you some heads up. Of course, there's a cheat code to this. Those who are enrolled with our essential course and the premium course have access to the F2 revision document. It has not been compiled as a set of PowerPoint slides with the purpose that we intend to give you more notes, and we try to design that material in the form of some tasks and answers. So if you still have not gone through that document, please make sure that you go through it, because we have incorporated some key points about WACC and its suitability when it comes to investment appraisal. And we've also seen that the examiner tests whether you are able to identify the impact of certain business decisions. For instance, the acquisition could impact the WACC of the company. So that's one example, and you will see that was tested in our mock 1 as well. So those who have attempted our mock 1 in full, you would have seen in section 3, we have incorporated a question with regard to WACC, where we are testing your knowledge on being able to identify how an acquisition may change Trimayr's WACC and the implications of any such change. So it's a 50% weighted requirement, mind you, and that means you will be you should be able to construct a response which would be in, say, 350 to 400 words, where you elaborate on how the WACC would be impacted due to acquisition and what would be the implications of a possible increase or decrease in the WACC. Moreover, we've also seen issues such as, say, for instance, a product recall. Now, product recall is not a directly relevant scenario for Trimayr, but just to give you some examples of how WACC has been tested in the recent past, I'm highlighting the fact that there can be certain events, some events that have a negative impact on the share price. How those events or deliberate business decisions could impact the WACC is something that you should be prepared to answer. So please take this topic back seriously and make sure that you cover all these areas as part of your preparation, whether you're studying with us or whether you're studying with a different tuition provider. I'm sure you will have these covered as part of your course. And then we move on to group accounts, another area which is definitely tested in every case study session. So you have two examination dates, May and August. You are likely to see a group accounts related task in at least one of the 6 papers, but we've also had situations where group accounts have been tested in, say, 4 out of 6 variants, because there are different areas which the examiner could test in relation to group accounts. We start with subsidiaries. So when you are looking at an acquisition scenario, the examiner could test your knowledge on accounting for a subsidiary at its very basic, how the subsidiaries addition will impact the financial reporting aspects of the company. So that would be straightforward. We've got a scenario covered in our F2 revision cards as well. And you could also be tested on the same with a foreign subsidiary. So your answer would be different in terms of how we account for a subsidiary which is operating in a foreign country, because there will be some translation issues. So we've got a scenario covered in the F2 revision card, which accounts for accounting for a subsidiary plus accounting for a foreign subsidiary. Now that would be the very basic. And here's the next subtopic the examiner can test. The examiner could very well test your knowledge on goodwill. And this has been one of the most popular areas in the examination, for the simple reason that students always underperform when it comes to goodwill. If you read through the examiner's report, as you know, there is a task by task breakdown of how candidates had performed in a variant, and you will often see that the examiner commenting that this was one of the poorly answered tasks in the examination. So at its very basic level, you will need to have an idea about what is meant by goodwill and the more popular question of the challenges of calculating goodwill in a given scenario. And remember, you cannot take a very standardized approach towards answering this, because the challenges of calculating goodwill will depend on the exact acquisition scenario. So in our 6 mock exams, we are covering 2 different scenarios. One is to do with a manufacturing organization and the other is to do with a service organization. And this will prep you towards tackling the task in the examination. So initially, we saw that the examiner was very keen on testing the challenges of calculating goodwill to the extent where the examiner would attach a 60% weighting to the subtask. And some candidates think when you have 3 subtasks, it's a difficult section. But sometimes you have 2 subtasks and you get a requirement where the challenges of calculating goodwill is weighted at 60%. You have the time, but you don't know what are the relevant points for this subtask. So this is equally difficult as having 3 subtasks. And in recent times, we have also seen that the examiner take this further by asking the candidates not only the challenges of calculating goodwill, but the examiner is also asking, all right, fine, tell me how those challenges can be overcome. Now that makes it even more difficult. So please make sure that you have a solid understanding of the concept of goodwill. And with regard to your preparation for the management case study examination, please focus on understanding the challenges of calculating goodwill in a given scenario. I repeat, in a given scenario. Don't go with a standardized set of responses, because depending on the company, the challenges of determining the goodwill will be different. And a further elaboration is covered in the master classes for mock 3. So you will get a briefing on that later. But for now, I'm just opening it up so that you can take this topic seriously and be prepared for how it has been tested in recent times. Thereafter, we have non-controlling interest scenarios arising. So remember, this is it's a scenario where you have minority shareholding in your subsidiary, and this could be a particular scenario if you are looking at a controlling stake, but it's not 100% stake. So say, for instance, you own 80% of the company, the remainder would be categorized as non-controlling interest. And then there are 2 methods of valuing non-controlling interest, the proportionate assets method and the fair value method. So depending on the method of valuation, you should know how we will account for non-controlling interest upon acquisition. And there can also be scenarios relating to fair value adjustments that could link to goodwill calculation, because remember, goodwill calculation starts with fair value adjustments. But we've also seen in the past examination questions, the examiner tests fair value adjustments post-acquisition. So just be prepared, and don't worry, this is a topic that we actually cover in our mock exams, because we do understand that many candidates don't have a background in group accounting. So you would be able to, address, you will be able to tackle questions on our mock exams. But I would also like to remind that the F2 revision cards include the notes, the theoretical background to fair value adjustments. And in addition to subsidiaries, you can also be tested on joint ventures. So please be prepared to be able to identify a joint venture agreement, because we've seen tasks where the examiner gives you information which is not clear cut. It's like a puzzle, and you will need to solve it, and you will need to advise the board as to whether you would classify the investment as a joint venture or it could be an associate. Yeah. So you need to have a solid idea about how we would identify a subsidiary, a joint venture, or an associate. Many candidates just think it's about the percentages, but it's not really about the percentages, because the percentages are an indication, and the percentages aren't the conclusive factor if you focus on the accounting standards. So please make sure that you are able to read the attachment, see what the arrangement is like, and be able to conclude, okay, this arrangement leads us to a joint venture. And if it is a joint venture, this is how we will account for it. So be prepared. We've seen scenarios of subsidiaries accounting, joint venture accounting, associate accounting being tested, and being able to conclude is also something that the examiner has increasingly become interested in testing due to the lack of technical understanding from the candidates. Thereafter, we move on to integrated reporting. I would say this is one of the favorite topics of the candidates because there are no numbers, calculations involved. So to start with, you need to make sure that you have a clear understanding, a conceptual understanding of the concept of integrated reporting. If you take any annual report of a listed entity in today's context, you will see that they are adopting an integrated reporting approach. So if you want to get an idea practically, just refer to one of the annual reports of a listed company. And of course, don't waste too much time. Just to skim through and see, okay, this is what we mean by an integrated reporting approach. And particularly, you will see that there are 6 capitals being reported in integrated reporting. And this is what the examiner has been focusing more in the examination. How various business decisions, for instance, an expansion decision, a diversification decision, or an acquisition decision, or some events, some natural events, or maybe some issues with regard to stakeholders, how certain decisions or events could impact the capitals of the integrated report. Sometimes the examiner specifies the exact capitals that he intends you to cover within the answer. Sometimes it's an open-ended requirement, in which case you should be able to figure out, okay, these are the key capitals that would be impacted, and that's what I'm going to cover in my answer. So please be prepared, because although the topic is easier to learn, it's not that easy when it comes to constructing a response, because you sometimes take it for granted and you start writing whatever you think is relevant without focusing on what exactly is being required in the subtask. So please make sure that you not only understand the conceptual background of the 6 capitals, but being able to understand the application to different scenarios is important. Then we move on to financial ratio analysis, a key component of the F2 syllabus. And remember, there are 4 main categories of ratios that you learn. Profitability ratio. So in terms of F2, you need to know about GP margin, the OP margin, and the ROCE. But if you look at the statement of financial performance for Trimayr, you will see that we are directly arriving at the operating profit. So our analysis for Trimayr would start with the operating profit margin, the net profit margin, as well as the return on capital employed. Now, there are other profitability ratios, but they are not within the scope of the F2 syllabus, so you need not worry about them as part of your preparation. Liquidity is another key area. So you should be able to understand the current and quick ratios, the ideal standards, and in the event you are being presented with the ratios, you should be able to arrive at a conclusion as to whether the liquidity position of the company is satisfactory or not. Moving on to the activity or the efficiency ratio. So we have 3 main ratios here. We have the payable days, the receivable days, and the inventory turnover days. And this gives an indication about how efficiently the business is operating, or it also gives us some breakdown with regard to the working capital management of the company. So in our financial analysis video, we have looked at the current scenarios, and you don't need to memorize all of these ratios, but some key ratios such as the ROCE and the gearing especially are vital in preparation of the examination. So capital structure, the gearing ratio in particular is important. You should know what the current gearing ratio of Trimayr is. You will know that Trimayr is a highly geared company. 45.9% is the gearing based on debt divided by debt plus equity. So you are almost there with regard to the threshold of 50%. So any question in the examination where you are being asked whether to finance an investment using debt, see if you can recalculate the gearing. you can recalculate the gearing if they specify how much funding is needed for the particular investment. So in that case, calculate the gearing. And if you see that the gearing is above 50%, you will need to hoist the red flag and say that, look here, gearing is exceeding the threshold of 50%, and therefore it would be concerning. So it will be very important for you to understand that the gearing ratio of the company at present, as well as the gearing ratio if there is any changes in the structure. All right, let's move on to the financial reporting standards. So a number of financial reporting standards are there. Although the syllabus weightage for financial reporting standards is just 20%, you have a number of financial reporting standards that you should be aware of. Don't worry. I would say these are, more straightforward areas if you know the basics of each of these financial reporting standards. So IFRS 3 relates to business combinations, goodwill calculation. So there is nothing to be studied separately with regard to IFRS 3, because when you are learning group accounts, you will see goodwill calculation, and within goodwill calculation, the main components of IFRS 3 are covered. So you don't have to put separate effort into learning IFRS 3. And IFRS 10 is also connected in a similar way. This is about consolidated financial statements. So as I already mentioned, it is about accounting for a subsidiary to start with. And you will cover the key points within the group accounts discussion itself. So don't worry, it's all covered within the F2 revision cards as well as within the mock exams. And then with regard to IFRSs, the examiner's favorite, IFRS 15, revenue from contracts with customers. Every pre-sim has had at least one variant involving the examination of IFRS 15. So how it can be tested in your case? Well, I don't want to give you any spoilers. It's upcoming in the mock examination. But I saw that there was a discussion in the group with regard to IFRS 15, and it was a bit worrying that one or two candidates had been referring to past variants. Now, the problem is how IFRS 15 applies to a scenario relating to Trimayr is different from how it would apply to a scenario relating to another case study. So I remember there was a task that was shared with regard to Flat Hall. So Flat Hall was actually providing accommodation. Their business model is different. They were taking deposits from students, and it's not the same as how Trimayr operates. So we don't have in any situation of receiving deposits or any advance payments. So IFRS 15 wouldn't work the same way for Trimayr as it did with Flat Hall. So you need to be very careful. It's a good thing that you are trying to understand how a particular topic has been tested in the past, but caution must be exercised that you do not try to construct responses which are not relevant to the case study at hand. So with regard to IFRS 15, please make sure that you remember the 5-step process of accounting, and one of the 6 papers will definitely test this area, if not more. Then we arrive at IFRS 16 leases, and I should say that I was surprised that IFRS 16 at the MCS exam tested both lessor accounting for the lease and lessee accounting for the lease. The reason why I was surprised was that IFRS 16 leases topic in F2 focuses on the accounting for a lease from the perspective of the lessor. The lessee accounting aspect is covered in F1, which is examinable in the operational case study examination. But 2 or 3 sittings back, we saw lessee accounting being tested at the management case study examination. And soon after that, we have made sure that we tell the students, look here, although it's not within the scope of the F2 syllabus, please make sure that you understand accounting for leases from the perspective of both the lessor and lessee. And the chances of accounting for leases being tested is extremely high, because don't forget, Trimayr has its own salons, and you will see that under non-current liabilities, we have loans and lease liabilities. So it is telling that, look here, the examiner could test accounting for leases in the examination. So please be prepared on IFRS 16 as well. Moving on, you could also be tested on IAS 21, and this is also something that candidates may see as a surprise, because if you take the current scenario, we don't have any foreign operations. So there is no chance of a foreign subsidiary. And sometimes we don't anticipate a question from IAS 21 because we rule it out saying, look here, we don't have any foreign currency transactions. But the examiner can surprise you. So, don't take any chance with any accounting standards. Of course, there are certain standards which are tested more often than not. As I pointed out, IFRS 15. That doesn't mean you can leave out the standards that have not been tested. For instance, a task on EPS, we had been covering that for a long time, and we were pretty disappointed that EPS had not been tested in any of the examination diets. But in a very recent sitting, there was a question on EPS. So you never know when a standard would be tested, and you can't take a chance by skipping a particular standard. So it could come down to your fortunes, and it's better to be prepared for misfortunes in the examination. Moving on, you could also be tested on IAS 24. So this is also an accounting standard that we have been eagerly waiting to see being tested. And so it will not come at the top of the list in terms of areas that have been tested in the recent past, but that's what makes it a risky IAS, because there is every possibility that the examiner out of the moon brings this topic into an exam paper. And IAS 24 is all about disclosures. This has nothing to do with numbers. So revising and studying the accounting standard is not going to be very cumbersome. So please make sure that you don't leave out IAS 24. IAS 28 deals with investments in associates and joint ventures. So remember, whether an investment is classified as an associate or a joint venture, the method of accounting is termed as equity accounting, and equity accounting is prescribed in IAS 28. So regardless of the classification, you will explain the accounting treatment in the same way. So please make sure that equity accounting is understood by you, so that you can explain the accounting treatment for associates as well as joint ventures in light of IAS 28. So IAS 38, earnings per share, I just pointed out that it was tested in one of the relatively recent sittings. And since we are a listed entity, remember, Trimayr, we have an obligation to report the EPS. So it is a relevant, accounting standard for us. If you take the last examination sitting, it was an unlisted company. So maybe you could have ruled out IAS 33, but even then, we did not take a chance. So in this instance, since we are told that we are a listed entity, we need to understand IAS 33. And then another popular examination area, IAS 37. So please be prepared, study provisions, contingent liabilities well, because one of the 6 variants, or at least 2 or 3, are likely to examine your knowledge on IAS 37. And it's likely to come up with what we call as a disaster variant. You have a problem in the variant. The variant starts with a problem. Maybe there's a legal issue, or maybe a customer is suing you, and then the examiner can nicely bring in IAS 37 into the picture. So it's a highly tested area, and please make sure that in your revisions you cover as well. And IAS 38, well, what can I say about this? The examiner always finds new ways of testing this accounting standard from numerous fronts. So even in our mock examinations, you will see that IAS 38 being repeated. And let me give you some heads up. What you may have written as a response to one task in IAS 38 will not be the answer for another task in IAS 38. It's not going to be the same. So please remember, in our 6 mock exams, you may see a same area or topic being tested again, but don't try to reproduce the answer that you read for the previous mock exam task. That is never our objective. We avoid repetition. So the task may seem the same, the topic may seem the same, but the expected answer will be different. So always, if you have the urge to reproduce what you may have learned by redeveloping answer plans for a previous mock, don't write the same thing, at least not the whole thing, maybe the introduction, maybe an explanation of, what is an intangible asset, the 2 criteria, but beyond that, the application could be quite different. So please make sure you study IAS 38 well, because at least one of the 6 variants, if you look at the history of the past papers, you will see at least one, if not more, sometimes 2 to 3 of the 6 papers had a task on intangible assets, because there are numerous areas that can be tested under intangible assets. So that's basically a syllabus breakdown for you. I hope this will help you in terms of preparation. I will give you time to raise any questions you have when it comes to the Q&A session. But for now, let me also try to take you through a discussion of a mock exam task. So I'm sure you have gone through our mock exam 1, and we had a task for you in section 2, which is what I intend to discuss today. So mock exam 1, I hope you remember the start. It had a theme of diversification, a likely scenario. So in our mock examination, we have looked at diversification into the beauty and wellness market. And the examiner could, have a scenario pretty similar to this. May not be exactly the same industry, but, a related diversification. It's something that we have seen in past variants as well. So the first section had questions on business model as well as business risks. So those who joined the webinar conducted by Nick on answering technique would have gone through the answer discussion for subtask B, which was on business risks pertaining to P2. And in one of the upcoming webinars, we will discuss subtask A, which is with regard to business models relating to E2. So as you move on to section 2, you see that you are being told that few weeks passed by and today's date is 1st September 2025. And to make sure that we make efficient use of the time, I will not take you through the entire task as well as the reference material. Let's try to keep it simple, because it can be too difficult for you to concentrate in the discussion for a longer period of time in an online setting. But to summarize, we are looking at acquiring a company, and in the reference material, we see the information pertaining to the company, right? And we have 2 subtasks. The first one being something in relation to E2, negotiation and the possible challenges. And it's subtask B that I would be focusing on today, because it relates to F2. So in summary, the board is looking to acquire a company named Grace and Glamour Salons. So it's a leading chain of upmarket full-service beauty salon in Dassland, and it is currently owned by its 2 founders, and they are still involved in the business. And the company has relied on debt capital for expansions, which is normal because it's a privately owned entity. And Trimayr intends to proceed with a full acquisition of G&G, and agreed to meet again to discuss the acquisition structure and potential sources of funding for the acquisition. Now, I've skipped the reading of the remaining parts of the section, but you are not allowed to do that in the examination. because there are two subtasks, and if you are to successfully answer both subtasks, you need to understand the background fully. So to save time, I have skipped the parts and I've just focused on what would be relevant for the F2 discussion. So the takeaway here is that the board is looking at acquiring the company as a 100% or a fully owned subsidiary. And another key piece of information is that the board is yet to decide how will we fund this acquisition, the potential sources of funding for the acquisition. So with that in mind, we can now focus on the subtask at hand. Explain how the addition of G&G as a 100% subsidiary to the Trimayr Group will affect the analysis of the Trimayr Group's consolidated financial statements for the current financial year. So remember, our financial year runs from 1st January to 31st December, and the section stated very clearly that today's date is 1st of September 2025. So maybe the acquisition would materialize in the last quarter of the financial year. Maybe somewhere in October or November, we may be able to finalize the deal and we may be able to legally acquire ownership of the company. So towards the end of the financial year, this subtask is being said to us, how will this acquisition or how will the acquisition of the company as a 100% subsidiary will affect the analysis? Sometimes the examiner could word this as interpretation. So let me reread it for you. How the addition of G&G as a 100% subsidiary to the Trimayr Group will affect the interpretation of the Trimayr Group's consolidated financial statements for the current financial year. This particular subtask has been adopted from the past papers, and that's why I'm saying this could be worded slightly differently, but the intended outcome is the same for you to be able to understand, how a stakeholder would be able to interpret or analyze the numbers. So some candidates had mistakenly started explaining the accounting treatment for a subsidiary. So, well, it's good that you know the accounting treatment, but the focus of this subtask is not really the accounting treatment for a 100% subsidiary. It's about when you are interpreting or analyzing the consolidated financial statements, what would be the impact this 100% subsidiary would have. And also don't forget, this 100% subsidiary is going to be added to our group, towards the end of the current financial year. So three key factors. It's a 100% subsidiary. It's going to be added towards the year end, second point. And the third point is we are not sure whether we are going to raise the funds through debt or equity. So these 3 points form the basis of our answer as to how it will affect the analysis of the Trimayr Group's consolidated financial statements. So I will take you through the answer plan, but remember what the examiner expects from you in the examination is a full-fledged answer. Right, so you have access to this answer in our website, and we have explained the analysis with regard to financial position as well as financial performance. And this answer has been based on examiners' published suggested answers for the past case study. So this is what the examiner is expecting from you. So don't think this is an answer that we have come up with. So if you have any reservations about the answer, if you have any points where you want to challenge the answer, perfectly fine. I would say you are challenging the examiner's published past paper answers, because when it comes to technical areas, you can understand what the examiner is expecting by certain subtasks. So this is the full-fledged answer, points explained in paragraphs, but for discussion purpose, we will refer to the master class answer plans that we use. And a gentle reminder that these answer plans that we are sharing with you are more detailed than what you are required to develop in the examination. An answer plan that you develop in the examination is for your planning and for your understanding. So it doesn't have to be, or it must not be as detailed as how this looks. So we give you answer plans so that any candidate is able to read and understand. So even the abbreviations we use would be ones that could be understood by any candidate. And we make sure that you are able to print these, annotate on these, we make sure that it's more student friendly. So that's why these answer plans are more detailed, and therefore, don't feel intimidated by the length and the comprehensiveness of these answer plans. So with regard to how the addition of G and G will affect the analysis of the Trimayr Group's consolidated financial statement. So we have 4 financial statements. And in terms of the management case study, our focus is mostly on the statement of financial position and the statement of financial performance. So what we've done here is that we are focusing on these 2 main financial statements. So as we start, we have to raise a concern. Look here, with regard to the analysis, one key factor is that how are we going to finance this acquisition? The mode of finance will impact the statement of financial position differently. So we are considering both scenarios. If funded by equity, this is what's going to happen for the analysis. If funded by debt, this is what's going to happen, right? So let's look at the equity option. So how will we be able to fund this acquisition through equity? Well, we will have to go for a new share issue. We may opt for a rights issue, or we may open it up for the others. Alternatively, equity could also come in the form of a share-for-share exchange. So we are not going to pay cash. We will issue new shares to the current owners of G and G, and in return for the payment in the form of shares, they will transfer their ownership of G and G to the Trimayr Group. So either way, new shares will be issued. So whenever new shares are issued, whether for cash or whether as part of a share-for-share exchange deal, the equity of Trimayr Group increases, and it will increase by the fair value of the shares issued. So depending on how much the price of the G and G Group's share is going to be, you will decide the equivalent number of Trimayr shares to be issued. So with regard to the number of Trimayr shares, you will arrive at the fair value, and the equity figure in the consolidated statement of financial position will increase by that amount. And remember, when equity increases, the gearing will have a positive impact. The gearing ratio will decrease because the equity component in the long-term financing is increasing. The opposite is true for debt. And remember, debt in this instance could come in the form of a bank loan. You could directly approach a bank and see whether you would be able to secure a bank loan, or since we are a listed entity, we can open it up in the capital market where we can look at maybe a bond issue or a debenture issue. So whichever mode you choose, it's going to increase debt. So that means the non-current liabilities, or more accurately, the long-term debt increases. And when the long-term debt increases, the gearing increases, and the gearing increase indicates increased financial risk for the shareholders as well as the lenders. So a small typographical error here. This is shareholders, not stakeholders, right? So when the gearing increases, it will cause some concerns to shareholders and lenders. And I will also need to demonstrate my understanding. Look here, the current gearing is 45.9%, or you can round it off and say it's 46%. And if we are going to take out further loans or further debt, then the gearing may exceed 50%, and the shareholders will perceive the company as a highly geared and a high risk company. So they may be expecting higher returns from our business because their money invested here is at risk. And even lenders, if they have lent us based on variable interest rates, or if we look at securing additional loans in the future, because we are a heavily geared company, the cost of debt will come at a higher price. So the interest that they may be stipulating for loans granted to Trimayr could be high. So those would be the implications if you opt for a debt finance. And those are the key points that you should have covered with regard to financial position. It's acceptable if a candidate had also discussed about goodwill, but we are discussing about goodwill later on. So for the time being, we have avoided the discussion under financial position. Right, moving on to financial performance. So this is about the profitability of the group. And remember, when it comes to analysis or interpretation of the financial statements, you should focus on the relative figures, not the absolute figures, but the relative figures. So this is where the financial ratio analysis topic becomes important. So with regard to analysis or interpretation, within the scope of our syllabus, the shareholders, if we go by what we've learned in F2, the shareholders would be looking at the return on capital employed as the primary ratio to measure the profitability based on the statement of profit or loss, the SOPL. So remember, the return on capital employed, or ROCE, is calculated as profit before interest and tax, also known as operating profit divided by equity plus long-term debt. And if we have to raise new funds, be it equity or be it debt, the new funding will increase the capital employed figure. In other words, it will increase the denominator in the ratio. And mathematics would tell when the denominator of a ratio increases, when the numerator does not change, it will lead to a decline in the ratio. So if the increase in the denominator is compensated by an increase in profit before interest and tax, the numerator, then it will have the effect of setting off. So say, for instance, the capital employed figure increases by 10% and the PBIT also increases by 10%, then there will not be any change in the ratio. But say, for instance, the capital employed figure increases by 10%, but the operating profit increases by 8%, then you are in for a ROCE, which will be lower. So the issue that we will have is we are going to definitely see an increase in capital employed because we don't have cash at the moment to the extent of funding an acquisition. So we will have to opt for debt or equity. And the question is whether the increase in the denominator can be compensated by an equal percentage, if not a higher percentage increase in the numerator, which is the profit before interest and tax. And the answer is highly unlikely. The reason is we are towards the end of the financial year. So we are here in the last few months of 2025, and we are going to prepare the consolidated financial statements as at 31st December 2025. So after acquisition, the profits that we will generate from G&G will be a smaller amount because the subsidiary has been part of the group only for, say, 1/4 of the entire year. And therefore, you can't expect the profit before interest and tax to increase significantly. And what this where this could lead is a reduction in the ROCE for the current year. So these are the most straightforward points that you could have brought up. And of course, there was a question in the WhatsApp group, could we have discussed earnings per share? Well, that's fine, because it once again looks at the profitability in relation to shares. It's an acceptable response. But if you are discussing ROCE, then you need not discuss EPS also, because pretty much it's going to be the same impact. You go for a share issue, the number of shares will increase, and the question will once again be whether the profit attributable to shareholders, in other words, the net profit, will it increase by the same percentage to make sure that the EPS does not drop. So that's a bit questionable. If you had discussed EPS, that's how your answer should have been constructed. But we are opting for return on capital employed because here we can cover both scenarios, whether we finance through equity or whether we finance through debt. The ROCE will see a decline unless the subsidiary performs extremely well and offsets the increase in capital employed by the same percentage, if not by a higher percentage, right? Okay, we move on to the somewhat complicated part with regard to goodwill recognition. And before we even start, I would like to highlight the fact that if you are coming across the concept of goodwill for the first time, then you may find this part of the discussion slightly difficult because you have not been able to revise or understand goodwill before. So please don't worry. If you have not done revisions or if you don't have the brought forward knowledge with regard to goodwill, please go through the topic of goodwill, and thereafter maybe you will be able to make better sense of this discussion. And this is something the examiner has included. So we have to make sure whether we also cover this point with regard to the analysis of the financial statements. So goodwill, remember, is the premium that we pay to acquire a subsidiary. So I'm not going to go and talk about the calculation and the issues and challenges. That's a different topic, and it's a different masterclass. It's already up there. So remember, when goodwill is recognized, it will increase the capital employed figure. So how does that happen? So remember, goodwill is an intangible asset. So in the group consolidated statement of financial position or the balance sheet, we will recognize a new asset, and that is goodwill. So as an intangible asset, when you recognize goodwill, it increases the assets of the business. And when assets increase, it also leads to an increase in group equity. Now, you may ask how. Well, this is where we need to look at it from the perspective of the accounting equation. So say, for instance, assets equal capital plus liabilities or equity plus liabilities. So when the assets figure increases, from the assets, if you remove the liabilities, you will arrive at a higher ownership, higher equity figure. So indirectly, when the asset base increases, the equity component of the assets, the net assets of the company, will also see an increase. So the goodwill recognition ultimately results in an increase in the capital employed figure. And once again, it's going to negatively impact the return on capital employed because the capital employed figure is increasing. In other words, the denominator in the formula is increasing, but if there is no corresponding increase in profit before interest and tax, then definitely we are going to see a decline in the ratio. So goodwill will have an impact on the ROCE, and it will be negative in the short term or negative in the current financial year. Moreover, we would also be faced with a situation of having to review the goodwill for impairment, because at the reporting date, 31st December 2025, we need to subject the goodwill to an impairment review. And if there is an impairment of the goodwill, say for instance, we overpaid the purchase price, and the company is not really worth how much we paid for it, and we discover it 3-4 months later, or post acquisition, we saw some negative publicity or some negative events surrounding the subsidiary, and therefore the valuation attached to the subsidiary is not the same. So if there are factors that lead to an impairment of the goodwill, it will lead to a reduction in the operating profit or the profit before interest and tax for the year, PBIT. This is because any impairment is charged against the operating profit of the business. So when the operating profit reduces, it will negatively impact the ROCE, right? But let's be optimistic. Let's be optimistic. We would have acquired, and it's only been, say, 3 months, and maybe within 3 months, we do not expect the goodwill figure to be impaired. Although in the past examination, we've had a scenario where soon after acquisition, a few months after acquisition, the examiner gives you a scenario and states it looks like the company has overpaid, and therefore we need to now subject the goodwill for an impairment. So with the management case study examination, we cannot rule out any possibility. But going by the argument that we are constructing, operating profit will reduce. We also need to say when there is a reduction in operating profit, it will also reduce the equity, because remember, any losses are charged against the equity. So when the operating profit reduces, if there's a loss for the year, we will charge it against the retained earnings. So the equity component will reduce if the business is making losses. So this reduction in equity will partially offset the negative impact on ROCE. So the argument here is that if the operating profit decreases, if the numerator decreases, and if the denominator also decreases, then the ratio will remain the same. Mathematically, it's going to be the same. If the percentage decrease or increase is the same for both the numerator and the denominator, then the ratio will remain the same. So that argument is what we are bringing up here. Look here, when the operating profit reduces, when there's an impairment, we will charge it against equity. So the equity reserves will be impacted. And that would mean, the impact of impairment on the ROCE would be partially offset by the reduction in equity. However, as I already pointed out, let's be optimistic. Okay, let's be optimistic. Impairment in 2025, December 31st is unlikely unless we significantly overpaid the purchase consideration. So let me remind you again, this part of the explanation would be somewhat difficult for you to understand at first if you have not gone through the topic of goodwill as part of your revision. But I'm open up. I'll open it up for questions shortly, and any questions, any clarifications you need pertaining to the explanation of how goodwill affects the interpretation of the financial statements, or how the different sources of finance impacts, I will open it up for you. But there was a cheat code for answering this in our F2 Q&A. We had included a task, we had included a heading under goodwill calculation, and in that particular topic, we had set a task for you to explain how the recognition of goodwill will impact the interpretation of the financial statements. So candidates who had revised those areas, gone through that material, may have been able to answer this requirement better. So don't worry if you missed out, but you will find the help. You will find the revision card helpful for this particular topic. So that's about my discussion of the subtask, and based on your questions, I will give you further clarifications on this. But let's also move on to the next section of the webinar, then the Q&A session. And before that, it's a slight reminder that the candidates who went through this process of attempting mock exams, having them corrected, unfortunately, the feedback option is now closed due to demand. And those who have actually gone through the process, whether they come from failures or whether they come from the gateway route, the FLP route, when you go through this process, attempting mocks, then studying the suggested answer, watching the master classes, leaving sufficient breaks in between the mocks, preparing yourself to better tackle, it will take you to a better, outcome in the upcoming examination. So that's what we have been able to achieve. And so trust the process and keep working hard, and you will also see similar results. All right, I'll open up the session for a Q&A, and let me pause the recording to facilitate the discussion. All right, thank you for your questions. If you have any more questions, please know that you can post them on the WhatsApp forum as well. And we have another webinar coming up next week, same time. So you can even raise the questions in that webinar. But don't wait till a week. Please reach out to us, especially through the WhatsApp group. You can post any questions you have. And let me also remind you to follow the updates on our social media pages, especially the YouTube and TikTok pages, where you will have mini clips summarizing some key points from the pre-scene or sharing some insights then and there, which you may find helpful. So workshop 1 reaches a conclusion, and thank you very much for attending today's workshop. Until the next workshop, have a great week and see you all soon. Thank you.